Hello, Facebook. Merry Christmas Eve. This is the 39.6 show, episode number 25, the show where we talk to you about how to make your money work for you so you don't have to work for your money. Pinky was left at home, and today I am actually broadcasting from my mom's basement. As average Joe Money would say he does, this is actually my mom's basement. So we are here for the holidays, and 'tis the season to tax loss harvest. If you've been paying no attention at all to what's been going on in the market, the American markets have been tanking for the past week, couple weeks, month or so, but steadily, basically every day over the past week. And so today I did another tax loss harvest, and I screenshotted basically every single slide to kind of show you the process, to talk to you about how to do it, and ultimately why to do it. I might have to split this into multiple episodes as I have like a bunch of slides and not too much time because it's Christmas Eve and we have things to do. But hopefully the other one, if I have to do two, will be broadcast soon. Okay. So that all being said, tax loss harvesting, let's get on with the show. Let's see if I can, okay. Hopefully, you see all the slides here. I think one person might be on here. If you can tell me that you can see this, that'd be fantastic. And that you can hear me, that would be great too. If anybody's out there, I did not announce this in advance. So if there's somebody there, if you can just give a hello, put a smiley face or something that you can see and hear this, that'd be fantastic. Okay, well, I am going to get started talking about tax loss harvesting. Okay, so just one second. Okay, so here we go. I can't put it into straight presentation mode, otherwise the screen thing doesn't work properly in BeLive. But if you're doing an IRA through the back door, you should be harvesting your tax losses through the front door. Okay, it's a little bit of a pet peeve of mine how much people talk about doing a backdoor Roth IRA as if there's some magic sauce about this. I mean, it is great to put money into another tax advantage account if you can. By all means, you should do it if you can and you feel like taking the effort to do so. But it's only $5,500 a year that you're not putting in a taxable account and you're putting inside a brokerage, inside an IRA instead, okay? So there is a marginal benefit to that. Physician on Fire did a great job of actually kind of walking through that, and I recommend you look at his article about the marginal value of the backdoor Roth, okay? But tax losses where you can actually offset your ordinary income legally, where the IRS gives you a very clear, well-defined path to do that, okay? These are things that for most of us who don't, A, own a business that can generate a bunch of losses, or B, are full-time real estate professionals and can capture those losses. For the rest of us, if you're at high taxation, you need to be taking advantage of every single tax deduction that the IRS directly gives us. And this one is actually an above the line deduction. So you don't have to itemize deductions to take this. It's one of the best ones. And this is far more valuable, in my opinion, than doing a backdoor Roth. So if you're doing that, please take the extra effort to harvest your tax losses. Okay. So how to do this? The first thing you need to do is you need to confirm that you actually have losses. Okay, so these are losses that are not yet realized because you have not sold the shares. So you're going to basically take unrealized losses and you're going to convert those into realized losses. Okay, now in episode 17, I walked through capital gains with Shinola's fund Toy Cubes. So I recommend that you review that episode just to kind of review about capital gains taxes. Capital losses is the opposite of a capital gains. It's when you have a negative, okay? And that's what we're going to talk about here. So I'm going to walk you through Vanguard, which is where we have our taxable brokerage account, okay? Now, Physician on Fire also has a great primer on tax loss harvesting. This walks you through it as well. And I have a ton of slides. So basically every single thing you would see when you're actually doing your own tax loss harvest, you're going to see here. Okay, I'm trying to make it so I don't crop off any of the slide. Okay, so you go into your Vanguard account, you log in. Okay, you click over here where it says My Accounts. Now you go to Cost Basis. Okay, the cost basis is what you paid to get an investment. Okay, when you click on that, you're going to get to the summary page, the cost basis summary. Okay, the first tab here is unrealized gains and losses. So these are shares that you have purchased, but you have not yet sold for a gain, or you have not yet sold for a loss. Okay. So at the moment, as of this morning, I had 2 investments. Okay, there are a couple things I cropped out of here, like my municipal money market account. But I had VFIAX, which is the original S&P 500 index fund by John Bogle. Okay, so this is like the first index fund. This is a huge fund, standard S&P 500 index fund. Okay, and I also have this Vanguard Large Cap Index Fund Admiral shares. Okay, and these 2 funds are very, 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 very close. The Vanguard 500 has 500 companies, and Vanguard's Large Cap Index has, I think, slightly more than 500, but it includes basically the first 500 and then like a little bit more. They are very identical, very, very, very similar, but they are not identical. Okay, and that is a key. Okay, now at the moment I had $89,000 in the S&P 500 and $5,000 in the large cap. I used to have more, but I did a tax loss harvest out of this. Okay, so at the moment I had these 2 funds for a total here listed of 94,000. Okay, those are the shares of stock funds that have unrealized gains or losses. Okay, so when you click on show details, okay, it'll tell you the date that I purchased, the number of shares I purchased, how much per share, and the total cost. So of this S&P 500, I actually bought all $89,000 of it just on Friday, December 21st, okay, at $223 per share. 401.064 shares. Okay, when you're buying mutual funds in Vanguard brokerage, you can have fractional shares. You don't need to have an exact integer number of shares. Okay, now on my Vanguard large cap, the shares that are residual in there were purchased August 21, 2017. Okay, they were bought at $56 per share, and the value of it has gone from $54.64 down to $54.14. Okay, so there's at the moment a loss of that fund of $50. Okay, an unrealized loss. And the reason why it shows it is because this is an old fund. Vanguard 500, that's about on Friday, and I did this morning, Monday morning, the 24th, and there was no losses listed yet because mutual funds are only priced at the end of the trading day. Okay, so basically there's neither a gain or a loss. Now, it says 1 cent, but you can just disregard that. The $50.45 here is a loss from the time it was initially purchased to the current value as of Friday afternoon. So this goes in the category of a long-term loss because it's more than a year old, these shares. Now, if I had purchased this Vanguard large cap on multiple different dates, which I had, it would list each date and the amount I bought on each date. The reason why there's only one at this time is because I have sold the other lots, we call tax lots, at other times. So I only have this one tax lot left. Okay. You cannot see because of the header. Thank you very much. Let me remove the header. Okay. My bad. Okay. I've moved the header. Thank you, Alicia. Okay. So now you can see the bottom third of the screen. You can see August 21, 2017, 97 shares. I've gone from $54.64 to $54.14, a $50 loss there. Okay. Now, this Vanguard 500, which I just bought on Friday, if I'm going to tax loss harvest it today, I need to know what it's going to be at the end of the trading day. So what I do is I look at an ETF. Okay, the ETF is something that's basically similar, but it's traded throughout the day, not just at the end of the day. Okay, so I look at VOO, VOO, which is also an S&P 500, but it's the ETF. And if I look at it, it's down 2.01% throughout the day when I looked at it. And that was at 12:37 p.m. Eastern time. Okay. Now, because today is almost a holiday, the markets were only open until 1 o'clock Eastern. So I checked at 12:37 to make sure that it was down. And it went down a lot. It went down 2% from 9 a.m. Eastern to 1 p.m. That was just in 4 hours. That's pretty fast, okay? And it's been doing 2%, did 2% on Friday also. So these are substantial drops, okay, sequentially. So I knew, unless it somehow recovered all that 2% over the next 23 minutes by 1 p.m., I knew that if I sold this, it would be at a loss. Now, if I had an international fund in here, which I usually do, but don't at the moment, I would look at VXUS, which is the ETF for international, basically total stock market. And if that is down for that day, I know that my fund will be lower than it was the day prior. Okay. So I bought this on Friday. I know it went down 2%. So I know I'm safe to sell this at a loss. If it had gone up above the original price from Friday's closing, then there would be a gain and I would have to pay taxes on that gain. We don't want to ever do that, okay? Because my gains are taxed at 23.8%, okay? So that's the Vanguard 500. Then if I look at the second investment I have, the large cap, I bought that on August 21, 2017. Okay, and remember, it's almost identical to S&P 500, but just slightly different. But they're going to be so well tracked, I can look at the same ETF. Okay, so I can still look at VOO, and I use this plot because it goes back to August 21, 2017. I plotted it here, okay, and then if we look now, okay, it's down. So I can also confirm that even though I knew it was down by $50, we know for sure that there's a loss here. Okay, it's actually going to be $50 plus the extra loss. Okay, so you want to basically check to make sure that you have funds that are at a loss. And the disadvantage of using mutual funds is that they trade based on the price at the end of the day, but you don't know what that price is. That's why the ETF is so useful. Okay. Benefit of using ETFs is you can trade that at any time and harvest your loss immediately. Okay. However, it takes longer for a trade in an ETF to go through. With a mutual fund, that trade happens overnight and your money is always exposed to the market. So by the next morning, the trade will already be done if I execute the order now before the trading day closes. Okay. I say now, but I mean this morning. Okay. So I've confirmed that I have losses there. Okay. So now I go to Vanguard right here where it says my accounts buy and sell. Okay. So this is step 2, exchange. Sell your losses and buy something else similar. Okay. So you do not want to buy something you have purchased within the past, within the previous 30 days. Okay. Let me move that over. I think you can see it better maybe if I moved it. Unless you can also sell those shares. Okay. Ideally at a loss or potentially just at a small gain. Okay. That's to prevent wash sales. We'll talk about it a little bit more later. Okay. So after you have gone to buy and sell, you are at this menu, you click Exchange Vanguard Funds. From there, you choose what you want to trade. Okay. So for example, the large cap mutual fund has $5,400. Okay. If I click on it, I see that there's only this one tax lot. If there were multiple different dates of purchase, each one would be listed one at a time. And each tax lot, it would tell me how much the estimated gain or loss was based on the previous day's price. Okay, we already saw this negative $50. Okay, and also we know that's a long-term loss. So we see this negative $50 if I were to select all of the shares that I have. Okay. And then after that, you hit, oh, sorry. But we also know that today's loss of 2% would be another $108 lost. So I have $108 lost from today's losses plus $50 from previous. So if I sell all of this today, I'll get $158 of a loss that's harvested. Okay. Which isn't much, but that's what it would be if I did it. I didn't actually do that one because I just didn't want to bother with such a small change. Okay. And also I have long-term losses there, and I want to have some funds with long-term that are long-term for potential donation of appreciated shares later on. Okay. Now, the other fund, okay, so I go back after I did that portion, and then I clicked on S&P 500 index fund. Okay. And that shows me the 401 shares that I bought on Friday for $89,000. Okay. It says estimated available proceeds is this amount. Okay. Which is basically the same amount from Friday. And it says it would be short term because it's less than a year old. Okay. If I click select all available shares, or all right here, it will choose all the shares I had, and I can choose then. Oh, I'm sorry. I've estimated the amount of loss I would have. So if I have the full amount of $89,437 and I have a 2% loss from today, it'd be a $1,789 loss. Okay, because 2%. Even though it says 0 right here, estimated gain or loss per share, that's because it assumes I haven't actually done anything yet, or assumes that we have Friday's sales price still. Okay. After that, it shows up here, and it says that I have 100% of these shares that are going to be sold. Okay. I chose from my brokerage account. I chose the tax lots that are going to sell. Okay. Then I have to choose where it's going to go. Well, I'm going to sell it here, and I'm going to buy something again in my brokerage. If you have multiple accounts at Vanguard, like a Roth IRA, a traditional IRA, all of them will be listed. Make sure you're keeping it from your taxable brokerage to your taxable brokerage. Okay. And then choose the fund you want to go to. So you could move it to the settlement fund, which is just your regular money market account, basically cash. And that would execute the sale. You would have the loss, and it would be harvested. But you would not have your money invested, so you would lose that exposure. Okay. And if the market went up by, let's say, 10% on Thursday and it recovers, well, you will miss out on all of that gain. Okay. And you will have been worse off by having harvested. Okay. So to do this with the least risk, you want to sell and buy something else very similar to keep your exposure. Okay. I know there are some people who don't do that. They just put it into money market for 31 days and then buy back. And that's fine too, but you lose that exposure. Okay. Now, Vanguard Large Cap is basically my first choice in the US stock market choices. Okay. Because it's very close to 500, S&P 500. But when I choose that and I say I want to buy all large cap funds, it gives me this alert. And basically, I've already sold this recently, okay, with another tax loss harvest. And it has these rules for frequent trading, okay? So excessive transactions can disrupt the management of a fund and increase the fund's cost for all shareholders. To prevent this disruption, purchases or exchanges back into non-ETF share classes of the fund are not permitted for 30 days. This limitation expires on January 20, 2019. So I just recently sold this on, I believe, December 21st. Okay. Or maybe it was December 20th. But basically it says I can't go back and buy back into this within 30 days from the last time. With an ETF, you can, but with a mutual fund, you cannot. Okay. So I can't do my first choice there. It's actually good because within 30 days, if I bought this, it would be a wash sale, and it basically kind of helps me from making a wash sale by accident. So that's a good thing. So I go to my next choice, and my next choice is a fund called Vanguard Tax Managed Capital Appreciation. It's also very, very, very similar to S&P 500. Okay. if you track this and Vanguard Large Cap, they are all almost identical. Okay, they're more than 99% correlated. So I type in that one and I choose that option, okay, as a minimum of $10,000, which I have enough money to get that minimum. Now, I don't have institutional money, so I won't qualify for the institutional $5 million minimum there. Okay, so I put in tax managed capital appreciation, and again, I also tax loss harvested out of that one very recently within the past week. I've been doing this like every day for the past week. So I can't buy that one. So I go to the next option and I have total stock market index, VT-SAX, the very famous VT-SAX that everybody likes to use for their total US stock market. This is a little bit less correlated with the S&P 500, but still 99% correlated historically. Okay. So I go to that, but I actually just tax loss harvested out of that one as well. Okay, so that was the one I sold on Friday when I did the trade for S&P 500. So I can't do that one either. Okay, so I've gone through like all of my American funds. Those are all my preferred choices: total stock market, S&P 500, large cap, and also the tax managed capital appreciation. Okay, so now this is not doing something substantially similar. Okay, I'm going to the international options, and I do that because I have American funds and international funds in my 401k, and I can do a trade there to kind of offset it. Okay, so now I look at my preferred international options. So Vanguard Total International Stock Index Admiral. Okay. $3,000 minimum. I have enough for that. Okay. Also, I get the alert here for excessive trading. So I go to my next option, which is the FTSE All World ex-US Index, minimum of 3,000. By the way, Vanguard used to have a 10,000 minimum for all their Admiral shares, but within the past month, approximately that all went down to, or in general, most of them went down to 3,000, which is what their minimum used to be for their regular investor shares. So basically, they're kind of getting rid of their investor shares. Okay. Now, this one also I traded out of. If you look at this date, it says I can't trade back until January 5. So I was doing some tax loss harvesting for international in early December. Okay, so I've gone through all my American funds. I went through my 2 total international funds. So then my third international option is developed markets. Okay, so total international is basically all the countries outside the US. Okay, developed markets is like Europe, Australia, and the Far East. My hands, I don't know if they're in here. There they are. Okay. And basically, developed markets makes up about 5/6 approximately 5/6 of the total international stock market. The other 1/6 is like the emerging markets. Okay, so if you have 5/6 of the total market, it's still going to be very, very, very well correlated. Okay, it's basically like S&P 500 to the total stock market. S&P 500 makes up about 4/5 to 5/6 of the total stock market. So it's about the same proportion. Okay, so they're still very, very well correlated. So I do that. And again, I'm blocked out of that one until January 9th. So I've gone through all my preferred American companies, American funds, and then, or US funds. And then I've also gone through all my international funds that are ideal. So I've gone through every one, but there's another 2% drop, which is another $1,800-ish that I can harvest. So I could just wait it out, okay? Or I could just say, I'm just going to do one more, okay? Just one more time. It's like you're at the casino, just one more, okay? So, all right, so what am I going to do? So I said, let's just do this. Let's go to Total World Stock Index, which is not American or international. It's a combination of both. It's about half, or like 5/9 of it is American and 4/9 of it is international, at least historically. So I could do that, and then I can just do a trade in my 401k to kind of keep my exposure the same. There are some other things I could do. I could split it up and do like half large cap value and half large cap growth, and that would be very similar to just the large cap or the S&P 500. But then I'd have 2 separate funds. I could just go to large cap. I could just go to large cap growth, or I could just go to large cap value, but then you're really changing your exposure. Although they're still very well correlated. So it's also a reasonable thing to do. I decided, let's just do total world stock index. I've never done this before. And so I added it on, and it took it, okay? Because I've never bought it. So I had 100% of this going to this. Now, I'm going through all of these slides, but if you know what you're selling and what you're buying, this whole process takes like 2 minutes. Literally, I can do it on my phone, just very quickly in the middle of the day. It's very, very, very easy to do, okay? But I had to go through this to show you what happens if you can't buy those funds. So if you have the funds, you just choose them, set the shares that you're gonna sell and what you're gonna buy. And once you do that, you hit continue in the bottom right corner. You're going to get this box, consent to electronic delivery of fund prospectus. Okay. And you can see the prospectus of it. You can see what it's made of. Okay. You'll get this next screen where it says review and submit. It says what you're selling, what you're buying. Okay. Now, if you click on this arrow right here, share selected, you can get more information. You'll see you had your 401 shares that were acquired on December 21. And the total cost of it was $89,437. This is like your timeout before going to the operating room, or once you are in the operating room. This is your timeout. Before you pull the trigger, you make sure that you are selling the right thing, okay? And you're buying the right thing. If you do this right before the trade deadline ends for the day, you can't like fix it easily. Okay, so there you go, December 21, that's being sold. And then I just scrolled down to show the second half of it, and you have that submit button, and then you get your confirmation. All right, so that's it. The first step was make sure you have losses. Step 2 was sell your losses and buy your replacement, whatever that fund is, okay? That is it. That's all you need to do to tax loss harvest. You do that, and you are going to have a loss show up on your taxes, okay? Now, let's see here. Okay, well, I'm just going to continue for a few more minutes. I'm sorry. Okay, so step 3. Okay, I've bought a new share. Okay, you want to set your cost basis of your new fund to spec ID if you have not previously done it. You actually want to do this for all of your funds in general. The only exception is, like, I have a municipal money market fund, and that doesn't really have gains or losses. It just stays the value of $1. So I just have that money because that comes every month. I don't tax loss harvest that, okay? And I just reinvest that. But for all of your stock investments, I have it set to spec ID, even your bond investments, because bonds can go up or down. You want those all to be spec ID, okay? Now, how do you do that? You go to My Accounts, you click Account Maintenance. It's kind of a weird heading for what it is, but that's what it is, Account Maintenance. Okay, so once you're in there, once you're in Account Maintenance, then you're gonna get to Cost Basis Methods. I might have missed a slide, but you're going to choose your cost basis method, okay? And you're going to see this where it says you can change your cost basis method, and you're going to see this right here. Vanguard Total World Stock Index does not have a cost basis method. My other two do have a cost basis method, okay? So I'm zooming in on that here, where you can see that Total World Stock Index has not, the cost basis has not been established. Okay, so you click on the drop down and you choose specific identification of shares. This is in contrary to average cost or first in, first out. First in, first out means if you bought, let's say 10 shares today and 10 shares yesterday, okay, and then tomorrow I wanted to sell 15 shares, well, it would sell the first 10 from 2 days ago and it would sell 5 from today and go in order, okay? Average cost, would basically do, if I bought 10 2 days ago and 10 today, and I go to sell 15 tomorrow, it would do like 7.5 of each, basically, okay? Now, once you've chosen specific identification of shares, then you get this pop-up box, you hit submit, and there you go. It has been changed to specific identification of shares. It's that easy, okay? Then you also want to turn off your dividend reinvestment, okay? And this is the same idea. So you go through the same steps. Sorry, okay, so turn off dividend reinvestment. This, like specific identification of shares, you don't have to do, but it makes everything cleaner, okay? And you just basically have to do this once for each fund, or if you have it set, basically it'll automatically have this off for all of your funds, okay? So the reason for this is because of a wash sale that can be generated by having a dividend, okay? So let's say 2 years ago on the New Year's, I bought 200 shares of the S&P 500. Okay. Now those shares are at a gain, so I don't want to sell them. Now on December 21, I bought 401 shares. Okay, that was on Friday. Now today, I sold those 401 shares because they went down in value of 2%. Okay, and that's fine. However, let's say on December 28th, a dividend from the first 200 shares, which are still there, they generate a dividend of, let's say, $223, which is exactly enough to buy one share. If I have automatic reinvestment on, okay, it will automatically purchase one more share. Okay, but that one share happened to be purchased within the 30-day window after the purchase, after the sell, okay, of these shares, December 24th. Okay, so only 4 days later. You don't want to have any purchases of the same fund that you sold within 30 days of the sale, either before or after. Okay, but it's not the end of the world. It's really not that big of a deal. People make a huge deal about wash sales, but it's really not unless your dividends are really, really big. Okay, but still, it's really not in general that big of a deal. Your 401 shares that you sold on Friday, you only have a one share that's going to generate a wash sale here. So you end up only qualifying 400 of them to be harvested. No big deal. Okay, so instead of having $1,788 or $89 of tax losses harvested, you only get $1,784. So you just lost like $4 of a tax loss harvest. Not a big deal. Okay, so to do this, you go to account maintenance. Okay, yeah, I missed this slide earlier. Here's where it says cost basis method. The one below it says holding level dividend and capital gains elections. Okay, so when you go there, you'll see these are all the funds that I have. Okay, Vanguard 500, total world stock, and municipal money market, large cap index, and then my settlement account. Okay, all of them are set for dividends to be transferred to the settlement fund and capital gains to be transferred to the settlement fund. Okay, the settlement fund is this federal money market right here. That's why it only has $408 in it. It's not much. And every quarter I just invest that money basically. Okay, now all of them are set to transfer to settlement fund with exception of, again, I mentioned earlier, the municipal money market. I just reinvest that money every month. Okay, it doesn't generate any capital gains. Dividends are basically all tax-free because it's a municipal money market account. And I don't do any tax loss harvesting with this one. So this one just stays at reinvest, but all the other ones go to the settlement account. Okay, it was already set that way, so I didn't have to change it. But if you did want to change it, you'd click on this box right here, okay, and then you just change from the drop-down menus so that you see transfer to settlement fund. Okay, you review and submit it, and then you would hit submit. But for me, it was already set that way, so there's nothing for me to do. Okay, then you want to confirm your loss, that it shows up in your cost basis the following day. So the next morning, you log into your account, okay? You go back to cost basis. You're going to go to the next tab where it says realized gains and losses. From there, you're going to see that you sold on December 24th shares that were acquired on December 21. It tells you the number of shares that you sold, how much it cost you to buy them, and how much you got when you sold it. Okay. And it gives you your loss here of $1,789. Okay, so you want to make sure that happens. I actually did a trade 2 weeks ago where I put the order in, and the next morning Vanguard had messed it up, and it didn't post. It happened to a lot of people. The trade order was done on time, and there was a confirmation. Always screenshot your confirmations anytime you execute a trade. Okay, FYI. But here it was. You go the next morning, you see it. Okay. Now, if you click on realized gains and you scroll all to the bottom, you'll see all of the, basically every single trade I did, all of the losses that I generated throughout the year. Okay. Short-term losses, long-term loss, total. Okay. Now, I don't have this much money in my account, but every time you sell something and buy something, it just makes a new ledger. Okay. So it all adds up here. Okay, but then what really matters are these numbers here. Okay, you have your total short-term losses, 11,800, and long-term losses of 400, and your total net loss here of 12,269. Okay, now after you've confirmed that the loss was done, okay, do not buy your fund again. Okay, for at least 31 calendar days from the day you sold it. If you wait the 31 days, you can go back and rebuy it if you would like to. Okay, that will not trigger a wash sale. But if you do it prior, it will. Okay, so for example, I sold these on December 24th, all 401 shares. If I waited only 30 calendar days, okay, January 23, 2019, and I sold all of my total world to go back to my S&P 500 fund, okay, and I buy the same number of shares. Let's just pretend that the value has been exactly the same, hasn't changed, okay? So I sold all those, but I also repurchased all of them within that 30-day window. So basically, all of the shares are washed out that were lost. So there are no shares here that qualify for a tax loss harvest. So I get no tax loss harvest, okay? So don't do that. Now, to fix that, if I had just waited 31 calendar days and waited to January 24 and I do my rebuy, okay, it should say no wash sale, I apologize. So I repurchase it after the 30-day window, okay, all the shares will qualify for the tax loss harvest. So you get your full 1,789. Okay, now, this is an example of a partial wash sale that can easily happen if you purchase something before you did your tax loss harvest. So let's pretend on December 1st, I bought 100 shares of S&P 500. And on December 21st, I bought 401 shares. Okay, so now I have 501 shares in total. On December 24th, today, when I did the tax loss harvest, I made a choice using specific identification of shares to only sell the December 21 tax lot, those 401 shares that I just bought that were down 2%. Okay. Well, I have 401 shares sold, but I have 100 shares that were purchased within the 30-day window prior to December 24th. So basically, from anything from November like 25th onward is within that 30-day window. Okay, so we did not sell those December 1 shares by accident. They should have been sold, but they weren't sold. So 100 of those shares, okay, because 100 shares were bought December 1, will wash out 100 of the 401 shares that were sold on December 21. So you only get to harvest 301 shares. So now your tax loss harvest is only 1,343 instead of 1,789. Okay, so you lost $440 of tax losses because you didn't sell this December 1 tax lot. Okay, and in fact, December 1, the market has gone down from then. So you would have actually gotten a loss from those shares and a loss from these shares as well. Okay, so after you've done your tax loss harvest, okay, and you've sat out the 31 days, so you haven't rebought and made a mistake to create a wash sale, you will eventually get your 1099B from your brokerage, okay? So this is a 1099B, but this is not what they actually look like when you get them from Vanguard. It will look like this, okay? So this is a Vanguard brokerage 1099B from 2017, okay? And you'll see this column here that says gain and loss, okay? Well, in this case, it would say like $12,000 of losses. After you have your 1099, you file your tax return. You need to claim your tax loss on your tax return. Okay, so this is where your proceeds will be shown, okay, and how much it costs you to buy them. And you have your loss. This is on Schedule D, your capital gains and losses. The top part is for short-term losses, okay, and we have about 12,000 here. And the second part of Schedule D is for long-term losses, things that you've held for more than a year. Okay, so I bought it for $20,000. I sold for $19,573, and here's a $437 tax loss. You add both the long-term and short-term losses together, you get this $12,270. Okay, when you combine those two on the part 3 of Schedule D, you'll see your total losses. Now, you cannot apply all losses in a given year. You can only apply $3,000 of losses. Okay, so 3,000 goes here, and the extra will get carried over. Okay, that 3,000 will get put on Schedule 1. This is a new tax form. Okay, this new tax form, you put the $3,000 loss, and then you will put that $3,000 loss on your 1040. Okay, it will go right here on Schedule 6. Form 1040 is new. It fits on a postcard. Okay, the loss, used to just go directly onto here, but now they added that Schedule 1, so you have to do an extra form, but it's no big deal. But if you had $700,000 of wages and you have $3,000 of tax loss, you bring your adjusted gross income to $697,000. If you're at the 37% bracket, that top income is where you're going to save that $3,000, that top bracket. So that'll save you $1,110. Okay, and that is where I have to conclude for today. We will pick this up with part 2. I apologize. Thank you guys for coming, and I will see you again hopefully soon.